Hello, everyone. I think you can see me now. I won't keep my picture up here for the whole presentation, but welcome. We're going to get started in just a couple of minutes. We're letting people log in since we have a lot of people who have signed up for this webinar. I can see your questions. If you've got any questions, feel free to type them in. I will get to them during the presentation. We're going to keep this call to well under an hour. The purpose of the webinar today is to introduce you to our new WebTrader, to talk about options generally, to show you how to use our platform to trade options, but also how to use the platform to hedge your positions and how to use the platform to trade the underlying assets. My name is Steven Reiter. I'm the designer of this product. I manage the options business for AvaTrade, and we're very proud of the WebTrader, which follows on the heels of our excellent mobile app, which you can find in the Google Play Store as well as the Apple App Store. Just look for AvaOptions and you can find us there. Same look and feel, proprietary screens, but the main objective here is to make options easy to understand, but still powerful for the professional traders as well. So it's now 2 minutes past the hour. I'm just going to give this another minute, and then we're going to get started. Welcome, Joe. Welcome, Jat. Welcome, Boris. Welcome, Ellen. Welcome, Elaine. Welcome, Paula. Michael. James. Everybody's coming in. Andreas. Keep it coming. I'm being asked for if there's a traduction en français. The mobile app is translated into 9 languages. If I speak French, you won't even understand my French. Years ago, you could understand my French, but I wouldn't try it today. But the mobile app is available. It will use your phone's language. So we've got English, French, Spanish, Japanese, Chinese, Russian, Italian, German, and Arabic. I think that covers it. The WebTrader will also get languages working in the near future, but right now we're working on building all the features to bring it up to the level of the mobile app, which we developed first. Welcome, Renee. Welcome, Douglas, Joe, Alessandro. Okay, so I think we can get started. I'm going to, let's see if I can minimize my picture a little bit. I'll put it up here now and again, just put it over to the side. This is our WebTrader. Just make sure I'm not covering up anything important. Am I down on the bottom of the corner of the screen? No, I'm up at the top. Let's see, let me figure out where I'm going to place this. I don't know how to place it, so I'm going to get rid of it. Okay, now you don't see me. All right, this is our WebTrader. Just 1 second. Let me just mute myself for a second here. Okay, you can see me. So let me just turn off my WebTrader. Here we go. Okay, now you don't see my webcam. This is our WebTrader. Let me just I can log right back in. The login screen looks like this. If you are an existing customer of AvaTrade, you can simply go to avatrade.com and log in. When you go to the accounts page, you'll have a button that says Web Trading. Click on Web Trading. It will automatically log you in to this screen. I'm going to log in just directly to my account, but you can simply access it. You can go to avaoptions.com or you simply go to avatrade.com and put in your email and password, then click Web Trading next to your options account, and it will automatically log you in. So that's the welcome screen. It's the same as you'll find on the mobile app. And again, with the mobile app, same story. You can log in with your email and password. And naturally, when I'm not on the wrong screen. Let's see where we are, why it's not logging me in. It's not logging me in for some reason, so let me try this one more time. I'm gonna go to AvaOptions.com, and I'll log in from here. Here we go. So it's logging me in, it's getting all of the parameters that it needs, and this is what our screen looks like. Now, what you see here looks like many other trading platforms. On the left side of the screen, you have various assets. We have the major market FX on the top left, and then you have equity indices, gold and silver and equity indices, followed by all the other currency pairs down the bottom. And in another version coming up in the coming week, you'll be able to select categories. In the main screen, this is our trading screen, and our trading screen is unique. You can see the asset we've chosen, which by default is Eurodollar, to trade spot. When spot means you're trading FX, you're just trading the asset itself. So you're trading just like buying or selling a CFD, buying or selling foreign exchange, not an option. I can add, I can look at different types of charts. Some of you may like the Heikin Ashi. I can change the candle size to 15 minutes or whatever you like. I can add indicators like a moving average. I'll put in my favorite color of a purple moving average. Looks like that. So we have where the market has been with 15-minute candles. And over on the right, we can see the profit and loss of entering into this trade. If I were to buy 100,000 Eurodollar, the market goes up, I'll profit. If the market goes down, I'm going to lose. How much am I going to make or lose? I can choose to see that in terms of price or euros or dollars, because this is a dollar account. So this is how many dollars I'll make. So if the market's moving higher from the current level of 121.50, if it goes up to say 122, I'm going to make 50 pips, which is $500, as you can see here. Want to set a take profit? If I click the word limit, I simply click this closing arc, and I can set my take profit at 122 by double clicking on that handle. And you can see that my profit would be roughly $500 because that's a little less than 50 pips above the current market. So this is a very simple and clean interface. We can put in a take profit. We can also put in a stop loss. Double click, put in a specific level. Let's say I want to put in a stop loss at 121. And there's how much money I can lose. So I'm putting in a take profit and a stop loss, 121 and 122. I'm limiting the amount that I can lose, and I'm limiting the amount that I can profit. If I were to go short by clicking on sell, then my profit is when the market's going down, so that 121 level is now a take profit, and the 122 is the stop loss. And you can see in this red and green profit and loss diagram, which we can expand, gray means we're out of the trade because we've now gone past our limit order. Red is losses, green is profits. There's buy, doesn't have to be quite that big. So it's a very clean interface, or I can simply put in the trade. So if I execute now, click buy again, let's put in that limit order. Let's put in just a stop loss at 121. Good, till canceled, execute. That's done, and in a moment it pops into the bottom, and there you can see I bought at 121.51 with a pending stop at 121. The pending orders are always in blue because they're cool, waiting for execution. So can choose any asset. You can choose the pound. You can choose gold. You can change your periodicity, as I mentioned. Whoops. That's something that we're going to fix. So there's history. And again, you can put in studies however you like. Now, suppose instead, let's talk about what we're really here for, which is options. The button that says spot, if I click that, I get my menu to choose what option to trade. We can choose to trade simple calls and puts, or we can trade strategies like call spreads and put spreads and butterflies and strangles. And if you don't know what they are, just toggle over to the guide. All the icons turn blue, and you say, what is a strangle? Strangle is buying a call and buying a put at different strikes. That's buying a strangle. And you can see what the payoff diagram looks like. You're going to profit. When the market moves a lot higher, you'll profit if the market moves lower. But if the market stays around here, you've bought options that end up being worthless and you'll realize losses. I assume that everybody can hear me, or you would have complained. Okay, good. One visitor can't hear me. If you want to see what it looks like to sell, there's a selling strategy. Let's just go back to a call. We can also toggle through everything. Let's look at the buy strategies. Got all the different strategies. And this is buying a call option. Let's click try it. This is what a call looks like. Now we have introduced one new element to the screen. We still have here the history, where the market has been for the past week, because by default, this is a 1 week option. You can see up here, the expiration date is 1 week. You can trade options on this platform from 1 day to 1 year. So we've got a 1 week option. We're showing where the market has been for the past week. And here we're showing where the market might go in the next week based on the implied volatility of the option, of the at the money option. The implied volatility is currently 5.81%. You see in the middle, V equals 5.81. The implied volatility is 5.81. That is a measure of how volatile the asset is expected to be. This is a number that's implied from the market prices for options. The higher the volatility, the bigger range we can expect for the market in the next week. So these white dots on the middle arc, this middle arc or parabola is showing plus and minus 2 standard deviations of movement for the next week. So we can say that we're 98% confident that the market is going to be between these 2 white dots in a week. And we're 68% confident that we're going to be within 1 standard deviation, which is this inner arc. And we're 99.7% confident that we're going to be within 3 standard deviations, which is this outer arc. So that's a fairly big range. So the idea here is to frame the risk of the trade, not to simply show you an unrealistic picture of the probability of making money. We want to show you a fair expected range for the market, and then you can decide, and you can look at that and decide if it represents fair value to you, if you think it's a good trade for your portfolio or for your view. So this is a call option. A call option gives you the right to buy, but not the obligation to buy an asset at a specific price on a specific date. So this is a 121.50 call. You have the right to buy euros at 121.50 against the dollar in 1 week. It will cost you 41 pips or 42 pips. You see here in the orange box, buy, you pay 0.0042. That's expressed in the same units as the price of the asset. So Eurodollar is trading at 121.50. This is 0.0042. That means your break even will be the strike of 121.50 plus the 42 pips that you're paying. So your break even would be 121.92, which you see here in the center of the, let's see, turn on my cross target, right here in the center where we cross from red to green, that's gonna be at 121.52. Sorry, 121.92. How much does it cost in dollars? Just click this white box. It's gonna cost you $427. You can also see it in the profit and loss diagram. In red, the most you can lose is $420. That's what you paid for the option. You cannot lose more than you paid for the option. However, if the market moves higher, you can have unlimited profits. As the market moves higher and higher, you have the right to buy at 121.50. So as high as the market goes, you participate 1 for 1 after having paid for the option. Now, suppose that option is expensive. You decide you don't want to pay 42 pips, you want to buy an option for less. You can change the strike. Simply use your mouse, change the strike of the option. Let's make it 122. A 122 call costs half as much. Why does it cost half as much? Because it's out of the money. You don't start to profit until the market has already passed 122, instead of beginning to participate right away. The delta of this option is in the middle here, D equals 0.31. That means it's a 31% delta. The delta describes the slope of the line right here at the current market level. The slope of the orange line is called the horizon line. This is what's happening to the value of your option today as the market starts to move higher or lower. So if you buy this option, your current profit and loss at the current level will just be the bid-ask spread. But as the market moves higher, you're going to start to participate until eventually you're participating 1 for 1. At expiration, your delta is going to be either 100%, because you participate for every pip that the market moves higher above the strike, you're going to profit as well. And down below, the most you can lose is what you paid for the option, so your delta can be no worse or no less than 0. The other thing we can say about this number called delta 31 is we can say almost perfectly that there's a 31% chance that the market is going to finish above the strike or above 122 at expiration. So 1 week from now, there's a 31% chance that we're going to be higher, at or above 1.22. An at-the-money option has a 50% delta. We're trading at 121.50 today. In a week, it's either going to be higher or it's going to be lower. So you have a 50% chance of being higher and a 50% chance of being lower. As you put your strike higher and higher, the delta gets lower because there's a smaller chance of being in the money. I'm being asked about options on stocks. We are working now on adding options on equity indices. And next month, we expect to go live with options on the S&P 500 and the NASDAQ. Once that's working well, we're going to add more equity indices, and then we'll get to work on options on stocks. Today, you can trade options on foreign exchange, gold, and silver. If I move my strike much lower, then the option is already in the money. The right to buy at 120 is already valuable because we're already trading much higher. Therefore, the delta is higher and the cost of the option is higher. Not only can you buy options, but you can sell options. Click the word sell, and you can see that if I sell this call and the market moves higher, I'm going to start to lose money with unlimited loss potential. And if the market stays where it is or moves lower, the option will finish worthless and I'll keep my premium. So you can think of yourself as being the insurer or the insurance company. You're selling risk. You're offering protection against risk. You're going to get paid for that, which is a great way to use options, because when selling options, you're earning premium. It's a type of income. It's not something that you can really replicate in the underlying spot market. I'm just going to put it back on buy. It's just easier to speak from that perspective. We have this orange line I discussed, which is called the horizon line. All of these, by the way, are expandable. Maybe it gives you a better picture of what's going on. So as the market moves higher, I'm going to start to participate today. At expiration, my profit and loss is either on the red or the green. Above the strike, I start to profit. Once the market is higher than the strike plus what I paid for the option, I start to profit, net profit. But the option has a value today as well. not just at expiration. You buy an option today, you can turn around and sell it if you like. And the movement of your P&L, the value of the option is shown in this orange line. Let me put this back at the money, 121, let's put it at 121.50. So the orange is showing the value of the option today. So if I buy the option today and I sell it immediately, I'm only losing the difference between the bid and the ask, which in this case is about $60 or 6 pips. Over time, I can simulate what it's going to look like over time. I take this horizon slider up here and I can see what happens over time. At expiration, I'm either going to be on the red or the green. The option only has the intrinsic value, which is the difference between the market and the strike. So that's up here in the green. Either it's worth something or it's worth 0. Today, it also has time value. And that's why the orange line is better than the red and green line, because I bought an option. But every day, as the buyer of an option, time is money. Your option is going to decay. And you reach the orange, the red or the green. If I look at selling an option, another way to say time is money. Over time, I'm going to start earning that premium. Today, if I sell the option and then cover it, I've only suffered the bid-ask spread. But as we move towards expiration, every day I'm picking up what's called theta, the Greek letter theta, which is kind of a T for time. I'm picking up time decay. Now let's go ahead and execute this option. Let's buy a call up here. If I buy this call, it tells me how much margin I'm going to need. I'm going to need, in the case of this account, which is a global account, not an EU account, the leverage right now is 100 to 1. If I buy an option on 100,000, based on the other positions that I have, I'm going to need an additional $250 of margin, which pretty much is what I'm paying for the option, $280. I click execute, and the trade will be done. It's just calculating margin on the back end. And you can see in the blue, I'm buying the 121.80 call. The trade is done. And there it is in my open positions right at the top. I bought a 121.80 call. And as I said, I have a mark-to-market loss of $60, which is my bid-ask spread of 6 pips. Close this. And we can look at something else, like buying a put. When you buy a put option, try it. A put profits when the market goes down as opposed to going up, right? A put gives you the right to sell an asset in the future at a known price. So I have the right to sell at 121.50. If the market starts to drop, I'm going to profit. If the market moves higher, the most I can lose is what I paid for the option. I'm going to go ahead and execute that one too. Done. So I've bought a call and I bought a put. It's going to pop into the bottom there in a sec. Here I can see my history of the trades that I've done. I have not closed any trades today, so we only have our open positions. There's our put. So I've got a bunch of positions now in the Eurodollar. I bought a put and I bought a call and I bought cash. And I can trade other assets too. I can also look at strategies. Let's do a call spread. Let's choose a different asset. Let's choose the pound against the dollar. And let's look at a call spread. A call spread has 2 legs. We're buying a call and we're selling a call. So I'm buying the lower strike and I'm going to sell the higher strike. I've got to pay for that up front, but what I'm really doing is I'm gaining exposure to the market at the current level, and I've got limited losses and limited gains. So this is a low-cost way of exposing yourself to the market, or a low-risk way of exposing yourself to the market. It's different than simply buying the market and using a take profit and a stop loss. So if I buy a call spread, my profit and loss looks like that. And actually, let me do a screenshot. I'm going to do a screenshot of that. so I can show it to you in a comparison slide in a minute. Okay, and now let's look at just buying the market. And let's put a take profit and a stop loss like that. So in my option that I was going to show you, where is it? Drag it, I'm gonna drag it in. Hopefully you can see it. Okay, can you see that? Can you see that? Okay, so we were looking at a call spread, and here on the right, we're looking at a take profit and a stop loss. In both cases, we've got limited loss potential because when I buy spot with a stop loss, I'm out of the trade once I hit the stop loss. The main difference here is that in a call spread, I get to stay in the trade all the way until expiration after a week. Right? I can buy the market. I have my exposure to the market. It's not really costing me anything because I've bought an option and I've sold an option. As the market moves down, I might start to recognize losses, but my maximum loss is defined. Whereas over here, my maximum loss in the spot trade with a stop loss is also defined. But if the market then turns around and goes my way back up, with the option, I'm still in the trade. I've slept well at night. I'm exposed to the market. I don't have to worry about the market dropping and then going back up again. If I decided to go long with a call spread, or even by buying a call, I know that I can sleep. I'm exposed to the market. If it goes higher, I'm going to profit. If I use a spot trade, like we did here, if the market goes up right away, no problem, I'm going to profit. But if the market first goes down and hits my stop loss, I'm out of the trade, and then it goes higher, and I don't participate. That's one of the points, the big features of an option is that it lets you put on a position, sleep at night, and wait for your profits to come, or wait for your view to be realized. Now, there are many ways that we could put on that exposure. We can use a call spread that's got upside potential with limited losses. If we go into our options strategy guide, we have other ways we can express a bullish view with limited risk. This one is simply buying a call option. This is a bearish view, so that's not expressing any bullish. If I look at the other side of it, I'm expressing a bullish view, but it has unlimited downside risk, so we don't like that one. Here's the call spread. We can also look at a put spread. If I sell a put spread, it's pretty much the same thing as buying a call spread. So you can go through here and look at all the different strategies and find out which one is going to be best for you, and which one is going to meet your view. Here's another one. Limited downside, unlimited upside. This is called a Seagull. Try it. I've got 3 legs. What I'm really doing here is I'm buying a call, and then I'm financing it by selling a put spread. So I'm selling a put and buying a put. I can do it here effectively for 0 cost. This cost me 0 today. If the market moves higher, I can have unlimited profits. If the market moves lower, I have limited losses. How much? I can see it in dollars. I can change the size of the trade. I can see how much margin I need. Everything's here ready to trade. I'm being asked about options on gold. Yes, Suresh, you can trade options on gold. In fact, our most popular assets for options trading are Eurodollar, cable, which is the pound against the dollar, and gold. Those are the 3 most popular products today. So that's what our trading screen looks like. Let me close that, and let's just go back to a simple call to show you. Let me turn off the guide. Let's trade a call. We can also put limit orders on options. So I can buy this option. Let's make this one longer. Let's go for 2 months. I want to buy a 2-month option. I've got 2 months of history. Things look bullish. We've got a positive trend. So I'm going to buy a call, which I like because I'm just a little bit nervous about the markets. But if the trend is right, I'm going to head into profits, right? But let's put in a take profit. We can put a take profit on an option just like we can on spot. I can double click here and I can put in a specific premium level. And I can see my profit and loss in price, or I can see it in dollars, however you like. So if I buy this option today, it's going to cost me 170 pips, and I put in a take profit at 700 pips. That means I'm going to make 530 pips. If I do this on 100,000, 200,000, there's my $5,300 of potential profit. So I'm buying a call and I'm putting in a take profit for when we get there. I click here and it doesn't require any margin because I have no other positions in the pound. Since my position in the pound against the dollar is empty and the only thing I'm doing is buying an option, no margin is required. You simply pay for the option. That's the most you can lose, and you can wait to make money. Of course, you can lose your premium. That trade is done. There it is in my open positions with the limit order, which is the take profit. You can expand the size of the window at the bottom to see everything. There's my history. We haven't closed anything yet. So let's talk about closing positions before we start answering more questions. Let's say I want to close this position. This is my Eurodollar call in 100,000. I bought a call. It's currently losing $50, but I want to close it. I just choose it. It populates in the upper screen. I cannot change the strike now because it's an existing position. I could add a limit order to it, but I don't want to. I just want to close the position. Execute. That trade is closed, and you'll see it's going to disappear from my open positions in a moment. I'll close that, and you see it didn't come through yet. Close trades, it'll show up here as soon as it gets to me. Something slow in the back end. Now let's choose instead, let's look at other positions. Suppose I want to look at my a combination of positions. I'm long cash, which is 100,000. I'm long spot, right? And turn this one off. Yeah, I'm long spot and I'm long a put. I'm going to choose them both. If I'm long the market and I'm long a put, you can see them both here on the same screen. It's the same thing as being long a call. Because I'm long the market, if the market moves higher, I'm going to have unlimited profit potential. But if the market moves lower, I'm protected by the put. So when you put them together, what I've really done is I've used the put to hedge my spot position. So together you can see the exposure. And in fact, I can choose all of my Eurodollar positions. I don't have any other Eurodollar positions, but if I had another one, I'd be able to see it on this screen as well. And I can see also how they behave over time. So let's say I want to add another position. Let's say I want to sell a call at 123 for a longer period. I'm going to choose Eurodollar as a new position for 2 weeks. Here's where we've been for the last 2 weeks. Put my horizon back here. Let's say I want to sell a call at 123. Not going to get a lot of premium for that, but let's sell it anyway. I sell it in 100,000, execute, and it will show up in my open positions. Sorry for the delay. Okay, that's done. And there's the position here. So now let's choose this open position. And I click here where it says choose all Eurodollar positions. And it's going to bring up our put, our call, and our spot position. So what have we done? We've got 3 positions. We're long the market. What have I got here? Oh, there's another position there. I don't want both cash positions. I only want one of the cash positions. So we've got 3 positions. I'm long a call. Sorry, I'm long the market. I'm long a put, which protects it. And then I've sold a call above it. So all the positions together now look like this. So we can really manage all of our positions all at once. We can see the net risk of our trades and decide what our exposure is and how we want to manage that risk. If I add that other position back in, I'm long a little bit more, and you'll see that in the profit and loss diagram that we're long all of them. You see now that my exposure looks a lot longer because of this extra position at the bottom, this other long position. Again, take that out, and it looks like this. And over time, you can see how things will decay. So you can see that we hit the expiration of the first option here after 7 days. Our position looks like this, but this short call is longer. It has another week to go. So we still have time value. That's why this orange line is still curved. And then over time, that starts to decay as well. So you really get to see how all of your positions perform over time. I can show it a little more dramatically like that. We have a whole bunch of webinars recorded that you can use to learn more about these features, and I encourage you to do so. I'm just going to hit clear. So now let me go to some of your questions, because I'm a fast talker. By the way, there's that closed trade. We lost $51 on it. Here's our history. We can see all of our opens and our closes and our cancels. I'm being asked, if you have an account with AvaTrade, can you trade on this account? Claudia, the answer is you simply need to log into your AvaTrade account and add an AvaOptions account. Once your paperwork has been submitted, once you've been verified as a trader with AvaTrade, you can simply add another account. It's not MT4, it's not MT5. You simply add this one. You can transfer funds from one account to this one, or you can deposit more funds straight into this account. You don't need to submit any more paperwork. Any more questions? Can we buy options on gold? Let me show you gold. There's gold. And I can change the size. We can change the quantity. Let's say you want to do an option on 300 ounces of gold for a week. And you don't want to spend, here's the price, here's the dollars. You don't want to spend $5,000. You want to spend $2,000. Just move your strike out of the money until your premium is $2,000. There it is. This option costs $2,000. I'm going to buy it. Execute. Up at the top of the page, you can see how much margin is available, what your required margin is, your unrealized P&L, and the account value. And there's our option on gold right down at the bottom. I can click it. That's what it looks like. And let's say I've spent $2,000 of premium. Let's put this in dollars. I've spent $2,000. I want to earn those $2,000 back. I don't think that gold is going to move a lot lower, so I'll sell a put. So let's go back to gold. Let's choose a put. Let's sell a put on 500 ounces. You can use a calculator or you can use a slider. I'm going to sell a put on 500 ounces and I want to earn $2,000. And so I'm going to choose this strike. I'll earn $2,200 at 1835. At 1830, I'll earn only 1,600. So let's choose an 1835 put, also for the same expiration date of a week. I'll earn $2,000. Sell it, execute. So now I've got 2 positions in gold options. I've bought an option for $2,000. I've sold an option for $2,000. There's a more efficient way to do that. There's a strategy called risk reversal, where in one trade, you can buy a call and sell a put. So they would be in the same amount, but you can do that as a zero-cost trade. It looks something like that. So I'm buying an option and I'm selling an option, and net, it costs me almost nothing. I'll profit if the market moves higher, I have no P&L or almost no P&L if we stay between the strikes, and I'll start to lose money as the market goes lower, and maybe that fits my view, and that's why I'm happy to do that. Now let's look at the positions. Take it from the open positions. You can see that's exactly what we have. The advantage of doing them through a strategy is that we give a tighter bid-ask spread in the options strategy instead of executing two legs separately. When you're buying one option and selling another option, execute them as a strategy. There you go. So these are my two existing positions. I've bought a call and I've sold a put. And you can see all the details of them. And I can even do, I could do a partial close if they had the same amounts, but they don't have the same amounts. One is in 500 and one is in 300. That's why you see the red slope is greater than the green slope. Right? The position on the bottom is bigger. I'm asked, can I run this platform by myself or a broker, and how much is the commission? There are no fees and there are no commissions when you trade on this platform with AvaTrade. No fees and no commissions. The prices you see are where you execute, and you can trade as long as you've got the account value. If your account value drops below 50% of the required margin, all of your positions will be closed out automatically. Just want to show you that I can also do a partial close. Let's say I want to close out the excess amount of this put. There's 500 ounces of this put. I want to close out 200 of them. I just move my quantity slider, click close again, execute. And we'll get a partial close. There you go. And you'll see that the open position is going to change to 300 in a moment once it arrives into our open positions. And then we'll have equal amounts of the two positions. Somebody just asking me something, another question. I'm being asked, are stop loss orders guaranteed? Stop loss orders are never guaranteed. Stop loss orders mean that once the market reaches the level you place as a stop loss, it becomes a market order. So if you put a stop on anything, whether it's an option or a spot trade, if the market reaches the level of your stop, we then turn around and execute at the next best level. So stops are not guaranteed, just like they are not in spot or on other platforms, whether it's MT4 or MT5 or anything else. So you see now that our positions in the gold are both 300 because we've done a partial close on that larger put, and now our P&L looks like that. And if I look at my history, we can see what we've done. We've closed 200, or look at our closed trades. There's that gold put. We sold 500 and then we bought 200 back. And I have to change the sorting because it's hidden. We've lost, sorted by this. There we go. That cost us $500 because it's either because the market went against us or the bid-ask spread or whatever else it was. Okay, more questions. Keep them coming. What's a straddle? Okay, let's choose another asset. Let's use the Kiwi, the New Zealand dollar against like the US dollar, a straddle. The straddle is buying a call and buying a put. When you buy a straddle, you have one strike. You can set it wherever you like. Generally, you set it right at the money. You're buying a straddle because you have the view the market's going to move higher or lower. You think the market's going to be volatile. The more volatile it is, the more chance you have of making money, either in the short term because the value of the options overall are increasing as volatility is increasing, as the risk premium grows, or because the market is trending quickly in one way or the other. And as I make the option longer, I have a slider here, you can see the confidence interval is growing as the option gets longer, right? For a year, the market can have a much bigger range. For a shorter period of time, it has a smaller range. You get a real picture of what's going on by using this slider and choosing your option expiration. What is a strangle? Strangle is very similar. Let's look at the pound. And I choose a strangle. Strangle is just like a straddle, but you have two different strikes, buying a call and buying a put, but you set the strike. So if you look at a range of the market and you have a view versus the range, you can set your strikes. For example, if I add some sort of a moving average here, I like my purple. I actually might be more interested in selling a strangle. I might say, look, the market's been fairly range bound. I don't think it's going to make it much higher. And I'm going to set my strikes relative to the history of the market. So here I'm selling both a call and a put. If the market stays or finishes within the range, plus or minus the net premium, I'm going to profit. So I'm earning, in price terms, 200 pips. I'm selling it for 196 pips, 0.0196, almost 200 pips. So I'm going to be profitable at expiration between 140, which is the call plus 0.02. So between 140 and 132.50. That's a pretty big range, right? Between 140 and 132.50, I'm going to be profitable. That's the beauty of selling a strangle. You're selling a call and a put, but if you hold it to expiration, you really can only lose on one or the other, not on both, because either the market will be higher, or it'll be within the range, or it will be lower. So that's selling a strangle. The mobile app looks just like this. The mobile app was built first, so it has some extra features. It has auto chartist trading signals, for example. It also has risk management tools, which are going to be available here this week, where you can see your net risk by currency pair, your net risk by currency, your net vega, which is your exposure to implied volatility, and other things, including some very nice bar charts and numbers that will let you understand how to hedge or to understand what your net exposure is to the market. That's all we've got time for today. Any other questions, please feel free to type them away real quick before I sign off. I try to keep these to 45 or 50 minutes. We're running webinars every couple of weeks, so please keep an eye on your emails for announcements about upcoming webinars. We've been focusing recently on the WebTrader, but we're talking about options. We'll do intro to options. We've got other things that we can do. And by the way, you can add other things like stochastics, which will show up at the bottom of your chart. You can edit this type of information. You get rid of them if you decide you don't want them, or you can edit them. We've got, get rid of the stochastic, and let's put fractals. Choose your colors. Pretty. Don't know what they are. Bollinger Bands, anybody? Let's make them thicker to see them. And we got 3 colors. Cool. All on one chart with your options, a very unique platform, and you have all those features on the mobile app as well. Okay, that's all we've got time for today. Thanks again. Thank you for joining us for this webinar. Please trade with the platform. Don't trade with real money until you understand what you're doing. Make sure you understand options. Feel free to send us questions. We do have chat right here. Chat with us, just click it, and some nice person will answer your question. If nobody's online at the time, we'll do our best to get back to you. So leave us your email or name so we can get back to you in case we don't catch you at that time. And trade well, trade responsibly. And just remember, options let you control your risk. They don't have to be used to take risk, especially not for unlimited risk. People often have the view that options are risky. Options are not risky when you use them to control your risk. When you're buying an option, that's much less risky than a spot trade, because a spot trade can have unlimited loss potential. Buying an option, you can only lose what you paid for the option. So that's great. Thanks again, everybody. We look forward to seeing you on here again, trading with us soon, and have a great day. And give us feedback anytime. Bye.